So hello, my name is Roy Thompson. I head up Carpenter Box Financial Advisors. With me, I've got Henry Wilson, investment manager at LGT Wealth. LGT Wealth are one of the investment management companies that we use. And as we've done over the last couple of months, just looking to touch base, perhaps over 5 or 10 minutes, just to give a little bit of a market update and take on board the view of people who are working directly in the investment management space on where we are from an economic point of view around the world. So I guess, Henry, welcome once again. I guess the big issues to discuss since our last recording was really around the US inflation rates. They were lower than anticipated, which I think the market, certainly investment markets, stock market, took as good news. I don't know if there's any sort of underlying thoughts that you might have on that at all.
Yes, very much a move in the right direction, a meaningful move in the right direction. When we looked at some of the analyst data, economic analysts and forecasters out there, I don't think anyone had forecast it to come in at the levels that it did. So it really does show that it was a surprisingly low figure. But as with any data point, you have to be quite careful about kind of extrapolating a trend. And one swan doesn't make a summer. So one meaningful move in the data point is clearly good news, but we are a bit kind of cautious and careful about kind of proclaiming the end of this inflationary issue and saying that this is the end of it. What will be important is that we assess and monitor the data over the coming months to see that data point becomes more of a trend. There was a little bit of reconfiguration or recalculation of how the methodology was done for a couple of the components of CPI, and that certainly did help to bring it down almost artificially so. So we'll continue looking and monitoring the data, but certainly good, but we were perhaps a little bit more cautious than the rest of the market in terms of extrapolating forward inflation from the data.
Okay, so sort of on a singular basis, it sounds like good news, but don't expect stock markets to get carried away going on up unless it's kind of repeated again and inflation consistently starts to fall, the US being perhaps a leader of that. Interesting to me, at least. Obviously, the US, data was slightly behind or lower than anticipated, whilst in the UK, the inflationary figures were slightly higher than anticipated. So it seems to be that we're going to start to get a little bit of a discord depending upon where you are geographically around the world. Any comments regarding the UK inflationary figures?
Yes, so UK CPI came in at a 40-year high of 11.1. And I think what was quite jarring about that is not only was it above expectations, I believe the market expectations were 10.7. Yeah. So it came in quite meaningfully above expectations. And at the same time, it would have actually been 13.8 were it not for the energy price cap. So, high, but would have been a lot higher. And first of all, it does show actually the impact of some of these fiscal moves that the government have put in place. So that's a good thing, I think. It shows that kind of it's helping this cost of living crisis. But I do think you raise a really interesting point about the kind of divergent monetary policy, divergent inflationary setups that we will have as we go into 2023, where UK and Europe as well are facing this energy crisis that is just not to the same kind of, it's not nearly as bad in the US. And so we might see that as we go through 2023, the US are able to pause their rate hiking cycle. Perhaps that they'll stop it at 5.25 or so. And as we get into the back end of 23, they might even be able to cut. But in Europe and the UK, inflation might continue rising, but the question is how much can they continue raising interest rates given that economic activity is already falling off. And the OBR even mentioned that the UK might be already within a recession that might last for over a year. Mm-hmm. So you have what is essentially the classic setup of a stagflationary situation of low or negative growth in an environment of high inflation. So it's not a good setup.
So what we've seen, I guess, over the last month is off the back of the more positive news in the States. You have seen a strengthening of world stock markets. They've had a pretty good month, actually, and that actually includes some of the UK markets. So are those UK markets looking through the localized data of what's happening in the UK and preferring instead to choose the rhetoric or the information that's coming out of the States as a bit of a guide as to what's happening. Is that what's happening there?
Yeah, so you've had a broad-based rally over the last kind of month or so, where almost everything has risen, and then that's been primarily because of the US data. You know, it's the US 10-year and interest rates are such an important reference benchmark for investors that it is kind of quite normal that you see these moves, and the market as a whole, the global market as a whole, almost breathed a sigh of relief when they saw that lower data point, because a high US interest rates being high can mean that the US dollar is also ends up sort of gaining in power relative to the other currencies. And that means that generally across the globe, liquidity is tighter. And that's what we've seen this year has been a tightening of liquidity that has caused this kind of the difficulties in market conditions. And that's why we've seen equities come off. But what we recommend going forward is, I think that it really does bring to the front of our minds the importance of identifying high quality companies and also being geographically positioned for the right kind of market conditions. So for us, that means avoiding the UK domestic. It means avoiding European domestic, trying to invest into global businesses, global franchises that have limited debt, experienced management teams, and the ability to pass on higher input costs to the end consumer. So if you can kind of get hold of all of those types of different factors, amongst others, generally you'll be quite well insulated from ongoing events. But just over the weekend, we've seen that, off the top of my head, Made.com, Wasps Rugby Club, Worcester Rugby Club, a whole host of other UK businesses have suffered over the last couple of months, retail businesses, sports companies. And we've noticed that actually there's been quite a material uptick in UK businesses going into administration, either voluntary administration or forced administration. And it really does show the signs of creaking and cracking within the UK economy, particularly those domestically orientated companies.
So what we might see as we move into 2023 is we might start to see a scenario where, we move from this broad approach, which seems to me at least to have happened over the course of the last 10, 12 years, certainly, where we've had markets either generally moving up or generally moving down, for example, because of COVID. What we might start to see is very much, localized performance. So the UK might perform quite differently from, for example, the US or the Far East. So understanding where your money is invested is going to become ever more important, and thinking about whether that's geographically the right thing, depending upon what's happening politically or indeed economically. And I guess that's part of that deglobalization that we seem to, we're very much at the start of, I would guess, and feels like it's going to become more prevalent as time goes by. Is that sort of a fair summary?
Definitely correct. We this theme of deglobalization and potentially seeing two distinct trade blocks of a kind of Eastern Asian trade bloc and then a Western UK-US trade bloc, with India pivoting between the East and the West, is exactly how we envisage this playing out. And the interesting thing is it'll probably have, it'll have implications on economic growth. It'll have implications on currencies. I.e., you might see the end of the US dollar being that kind of the reserve currency of choice. You might see the renminbi or the Indian rupee getting a growing role in the global payment networks. And we've seen that this year with Russian oil being transacted in rupees and renminbi. And then finally, it'll have...
I'm ever so sorry, Henry. We just seem to have lost the recording there.
On things like inflation.
Henry,
Sorry, Roy.
Yeah, so no problems at all. We seem to be having, that's the trouble with filming these things live. So you were talking about the rupee and the strengthening of that currency and the fact that it's being used with to purchase Russian oil, for example. And I think you were extending on from there.
Yeah, so we might kind of see more of that, where you see more of these other currencies come into circulation. But the final point really about deglobalization is this idea of friendshoring, which is where if you take a US business that has supply chains through China, for example, because of your concerns around the ongoing trade war and things like that, and Taiwan and China, what you might do is you might either onshore some of your production, either into say Mexico or Canada or the US, or you might use other periphery Asian nations such as Vietnam or Thailand or Malaysia to fulfill the same sort of supply obligations. So we've seen that a bit in India. Actually, Apple have started producing a number of phones out of India, or concerns around China. So this still have impacts globally, but it should also help to kind of improve some of those smaller economies such as Vietnam or Thailand, etc.
And I suppose over time, what will happen is it will resolve or complement, or say complement, but it will help some of those supply chain issues that are still very much there for, opening up other channels, I guess. But so Henry, I really appreciate you taking the time once again. It sounds to me like the big news is, let's watch what if we start a trend in the US. We would be hopeful that sort of reduction in inflation is one that continues, and we might be able to start to see slightly more positive 2023, certainly in the US, and how that then bleeds over into the UK, Europe, and the rest of the world will sounds like that might be a little bit of a secondary question, but hopefully some slightly more positive news from an investment perspective if that is the start of a trend.
Absolutely.
Yeah. Henry, thanks so much for your time. I really appreciate it.
Have a good evening.